Good morning, everyone. Thank you for joining us in today's Learning Saturday initiative, where we're going to decode some of the shifts that are happening in monetary policy. I think data that has come out in July as well as August has given us a lot of food for thought in terms of where monetary policy is heading, what kind of investment opportunities are there. And the structure of our webinar is fairly simple. We are going to walk you through certain data points, and then we'd have a dedicated time for Q&A towards the end of the webinar. I'd also be happy to talk to you about the work that we do at Milestones2Wealth. So without further ado, I'm going to start because I do see that there are a few people in the room, and we'll stick to the timers that we've set out. So one of the reasons we wanted to talk about navigating monetary policy is because an asset class that has been looked over in 2025 has been fixed income. So I think with the performance in precious metals, a lot of people are thinking about safer investments. But when you've already seen so much performance, I think it's time to look at an asset class where that performance hasn't really kicked in. And also, structurally, we're at an interesting point for fixed income. So that being said, I think we'll start with the US. I think there are basically three economies that we're going to cover in today's webinar. We're going to look at the US, we're going to look at Japan, and we're going to look at India, and then we'll try to see where we fit into this whole scenario. So on the US front, I think the FOMC August was an important month because you had like an announcement that came in towards the end of July. You also had Jackson Hole Symposium, which is one of the biggest symposiums that occur for central bankers. And then, of course, you had the Fed minutes come out, and all of these, and the Fed's review on their longer term policy. So when we look at all of these things together, there is a sense of direction as to where US monetary policy is heading. So the first thing that we want to look at is what was the last decision that the Fed made, and the decision was to keep interest rates as they were at 4.25 to 4.5% because they still felt that there was a lot of outlook certainty. And in today's context, that still holds true, right? Because if we think about where tariffs are heading, you now have this being contested in the Supreme Court to understand whether the president actually has the authority to impose tariffs on other countries, or is that something that has to go through Congress, right? So that uncertainty is still there. But when we look at the finer details, one thing that stands out is that this was not a unanimous decision. And by and large, for a long time, and I'm talking about 10 years plus, decisions at the Fed have always been unanimous. So there are early signs of divergence within the committee itself because two members actually voted to to lower interest rates by 0.25%. So the Fed has been committing to a path of lower interest rates in 2025, predominantly because they feel that the balance of risks is tilting more towards unemployment and a recession rather than keep on the inflation front. This being said, I also the other important thing was one member did not vote at all. And she shortly after that she resigned from the Fed. So, like I mentioned, the other big event that took place is the Jackson Hole Symposium. And this is something that occurs every year. And you have central bankers all over the world attend this symposium. And then you get a lot of insight into what different central bankers are thinking about in terms of monetary policy. So, at Jackson Hole, I think we finally heard from Powell. So, there's been this war between Powell and Trump, where they've been back and forth on whether the Fed should have cut rates. Trump has publicly said that he's been too slow in lowering interest rates. So Jackson Hole was a turning point where we saw the Fed chairman actually say that, okay, policy is in the restrictive territory. Potentially the economy needs more support. And the signal and the tone of that message was that the Fed would start cutting rates as early as September. Now, this is something that was expected, given that the Fed has to have two rate cuts in 2025 based on their projections of where the Fed fund rate is going to settle at. Keeping all of this in mind, I think what does stand out is that inflation risks are still persistent for the Fed and the US economy, primarily because one, the tariff related impact is always going to be inflationary for the country that imposes tariffs, because essentially you're still going to import those goods, and that excess uh, amount that the tariff has to be paid by someone, right? So typically that tends to be the end customer. So it's not good for the country that you're trading with, but it's also not good for you in terms of managing inflation. So this tariffing is something that has actually going to have longer term effects. The Fed is still waiting to watch and see whether this is going to create like a one-off impact on the price level, or if it's going to be something that can be more longer term or persistent in nature. But even outside of tariffs, I think the thing that you want to look at is how persistent inflation has been. And your core inflation is actually not coming down in a meaningful way. And like the chairman said, you are in restrictive territory. So when you've already got rates higher and you're still seeing inflation, then it's possibly not money related inflation, and it's probably more related to prices within the economy in terms of goods, services, labor, uh, or commodities in terms of demand and supply. So these are harder to control for with policy rates, right? And I think the big data point that we also are keeping an eye on is the revisions in jobs data that the Fed has done. So they revised June and July data by almost 250,000 jobs. So jobs that were reported or statistically expected to have been filled, you had almost 2.5 lakh jobs that did not get filled in those months, and they had to revise their estimates downward. So this shows that maybe you're not really at maximum employment, or you're heading towards like the peak, and then you have to fall off from there. So the case here is that the Fed actually does not have too many options on hand, because you can't wait for a recession and then react. Everybody knows that monetary policy acts with a certain lag. So you're going to see some effect of a slowdown, and monetary policy has to react to that before the slowdown occurs for it to be effective. Now, even in India, when we look at what has happened on the interest rate side, you had 1% interest rate cuts, but then you've not really seen that transmission fully in the economy on day one, right? So our interest rate cuts happened by June, and in August and September is when we're seeing that full, almost that full level of transmission. So coming to the third event, as far as the US economy is concerned, I think here the Fed every 5 years they look at their long-term monetary policy strategy, and they come out with any changes that they might announce on that front. So as far as long-term monetary policy is concerned, I think number one, the Fed was keen on keeping inflation target at 2%. So I think prior to the announcement, there was a lot of speculation as to whether they would lower their inflation target or not, or they would increase it, because considering that inflation has been persistent, perhaps 2% isn't the baseline and it's going to be higher. And if you're heading into a higher phase of growth, lower liquidity, you might actually see more inflation that sense. But the Fed still feels that 2% is the normal level of inflation that the US economy should target. What did come out though was on the unemployment side of the mandate, where they said that, it doesn't really make sense to have an unemployment percentage as the target unemployment rate, right? Because unemployment is a lot harder to quantify than inflation. For example, this is because, like, let's say somebody is a part-time worker or somebody has multiple jobs, that should not get counted as more employment, or in the first case, you don't want that to be counted as unemployment. Just like how India has a lot of informal unemployment, I think that also persists in the US. So it becomes a little bit harder to track what unemployment numbers are, and it tends to be people who are actively looking out for jobs. So people who are not actively looking out for jobs, but may have given up on finding a job, but are technically would qualify, don't show up in those metrics. So then it's because it's a little bit harder to look at what unemployment really is, and how that matters. And also, in another sense, which the Fed brought up, which is that contextually there might be a certain level of unemployment that you're targeting, right? So, in a given part of the economic cycle, you would tend to see higher unemployment. In another part of the cycle, you would tend to see lower unemployment. So having a fixed number doesn't really make sense. This is essentially what they have said as far as unemployment is. And if we look at the strategy that the Fed has also been using, it has been like, you see sometimes their foot is on the unemployment accelerator, sometimes their foot is on the inflation control, right? So you see that balance of risks really playing out depending on where they see a higher level of risks emerging from. So if we look at the phase between, say, 2021 to 2023, there was a lot more focus on inflation. Initially, I think in 2021, they weren't particularly worried about inflation. So they kept saying that whatever we're seeing is more transitionary in nature. We don't think that it's going to be particularly long term. And I think by 2022, they had to acknowledge that no, like this kind of inflation is here to stay. So then you saw this big shift in terms of focusing on unemployment and keeping economic activity open in, say, in the post-COVID years of 2020, 2021, to a more strategic shift in terms of bringing inflation under control. And whatever we've seen so far, like inflation has been moving towards that 2% target, but that last mile of disinflation has really not happened through monetary policy. And you are seeing signs of inflation picking up. And I think with the tariffs and all of this in place, you would see a higher level of inflation going forward. So this has been significantly restrictive in terms of what they can do with interest rates so far. But given that that the economy is a little bit tight, you are seeing slowdown. That slowdown has been visible, right? If you look at the continuous sort of reduction in growth expectations that the Fed has announced from each economic projection, then it becomes clear that there is some requirement for support on the growth side of their mandate as well. So, as far as the long-term strategy is concerned, I don't think they've really made much changes. They have elaborated a lot on what unemployment is and why it needs to be more contextual rather than absolute in nature. And they have stuck to a review period of 5 years. So again, their longer-term policy will get reviewed in another 5 years. So moving on to Japan, I think here uh, Japan has actually had a very interesting interest rate history. So you've had their real estate bubble, then you saw Japan really move into like a decades of slowdown, and interest rates were actually negative between 2016 and 2024. Right. And in 2024, they moved from minus 0.1% directly to 0.1%. So that was a big jump. And you saw the market actually react a little bit violently to this because when you've had almost 1 decade of negative interest rates, there have been leverage trends that have occurred at a global scale. And you saw some of that unwinding, and we'll get into a little bit more detail just shortly. But if we look at the first rate hike that happened in March last year, and then you had another one in September, and I think the September rate hike actually caused a lot of drama within the global landscape. And then the next rate hike actually happened in January this year. And since then, you haven't really seen interest rates in Japan move up. But what has happened is for decades together, in the Japan was trying to bring inflation up because you had zero inflation for 15 years or so. and the target was about 2%. But with this rate hike and all the changes that have been happening globally, Japanese inflation has actually gone up to 3.1%. So it's significantly above target. So we're talking about an economy that hasn't experienced inflation for decades, which is suddenly experiencing inflation. And one way to, and policy has been easy for these past few decades, right? So one way to sort of dial that back is to make your policy more restrictive. But when you make your policy more restrictive and you increase the cost of borrowing, then that global interconnectedness that we saw last year kind of plays out. So there's a delicate balance or a delicate thread that's holding everything together. So if we look at Japanese interest rates, right? So from the 90s, we've been more or less uh, stable, right? So if we look at, say, from 1994 till now, we're more or less at the same level, like we're below 1%. So you had your real estate prices, you had your, and then you had like a steep decline in interest rates in the 90s. And then you kind of stabilized until the dot-com bubble, and then again you went into lower interest rate territory. And then we've kind of moved towards this phase of looking at positive interest rates. And this is essentially how you need to reverse something that has occurred over 20 or 30 years. And it's not going to be easy to do that. And there's a new sense of how you need to approach monetary policy. So if we look at how the 10-year yield has reacted in this time frame where interest rates have actually gone up, start of 2024, your 10-year yield was around 0.6, and now it's close to 1.6%. Your 30-year yields are significantly higher. So this is a pretty big jump because you're seeing almost 3x in terms of the yield movement, right? So we'll talk a little bit about the yen carry trade, which was in the news last year. And since nobody has really talked about it, but we're also at an inflection point where Japan needs to make a decision in terms of where it sees interest rates going. So if we look at the interest rate territory, they were near zero for decades. And it was negative in that 8-year period between 2016 and 2024. So this has essentially made yen denominated loans, very cheap. So it was easy to borrow in yen and then repay in whatever other currency you were using. So essentially what people were doing was they were borrowing in yen at a very low cost. Then they were converting the yen into another currency, like let's say the USD, and then they would buy US denominated assets. So this could be things like treasury bonds, emerging market bonds, or even real estate or stocks, right? Then you're earning US economy returns, which would be, so let's say you have a differential of 5% or 6%, and then you're paying out back in yen where you're literally your cost of borrowing is close to zero. Right. So this was a risk-free way to make money for a very long period of time. And you also, in this period, in addition to having this zero interest rate, you saw that the yen was becoming cheaper. So you had like a devaluation of the Japanese yen. So then not only are you earning returns in your dollar-based asset, when you're paying back, you have to pay back less because you get a better conversion rate, right? You can buy more yen for less dollars. So in this entire trade, you had risk-free returns because all the drivers were in your favor. Your cost of borrowing was cheap, your conversion was more favorable, and you could continue to repeat this. So this is how a lot of leveraged global trading was taking place in the last decade or so. And because you had this leverage play out, now you own like the basic concept in leverage is that when it's in your favor, you make significantly more returns. But if even one element goes out of balance and is not in your favor, then the losses start piling up. And this can be a big trigger for global volatility. We actually saw this happen last year when the second rate cut went through. So what are the triggers that can sort of push this? And I think one is in terms of the yen appreciation, right? And that's essentially what happened last year. You saw a very short period in which the Japanese yen just significantly appreciated, and that triggered a lot of unwinding of trades because you had to settle positions, etc. And then when the yen strengthens, or if the Japanese central bank starts increasing interest rates, then your cost of borrowing also starts increasing, right? So then not only do you get a more unfavorable exchange rate, you also tend to get have to pay more via your interest costs. So now we'll move on to India, and I think if we're looking at Indian interest rates, we have been in this range. We've had actually a fairly interesting interest rate cycle. So I think between 2010 and 2023, we were really going through an upward cycle, especially because your inflation was out of control, your CAD was out of control, and then you had to suddenly sort of uh, bring your interest rates down. Then we went through this period of cleaning up balance sheets with some impact on economic activity. Then, of course, by the time we were able to stabilize all of that and we saw a slowdown in the economy, that actually happened even before COVID. So 2019 was actually a low growth year. And then you had COVID, so you were forced to bring interest rates down. I think during COVID, India was one of the more responsible central banks. So we didn't end up cutting interest rates as much. And this actually worked out more in our favor because the rebound since then has been stable. Then I think you saw a period where your interest rates went up, especially as global inflation also moved up. And India was actually earlier to ease interest rates with this year's rate cuts happening in February, April, and then June. So we had a 0.25% cut in February, another 0.25% cut in April, and then we had a 0.5% cut in June. The basic idea here being that the central bank actually wanted to act quickly in terms of being able to act first and then allow some time for transmission. And we will be going through some of the minutes from the RBI policy and to sort of get a sense of what different policy committee members were really thinking about when it came to that decision to keep the stance neutral as well as to keep rates where they are. So our stance shift has also been pretty clear. We've been in neutral for a long time. We didn't really have any interest rate cuts post 2023, I would assume. And from there, we've been in a stable zone. So we moved into accommodative in April, and then we moved back to neutral in June. So I think here the key highlights are we've been at 5.5%, marking the second straight pause, right? So you had August and you had June. Your policy stance has been neutral, so you have been in wait and watch. As well as when it comes to inflation, there has been a significant revision in the forecast where FY26 inflation has reduced from 3.7% to 3.1%. So that essentially is what could give policymakers room to cut interest rates further. When we look at the GDP growth projection, the forecast was around 6.5%, and we will talk a little bit about the Q1 numbers that have come out towards the end of the presentation. So most of the risks that the RBI is really looking at are more external in nature. They're not about the domestic economy per se, but they do feel that exposure to global economies is putting us at risk in certain areas. So potentially, I think the biggest of those is the tariffs and the trade tensions that are emerging out of that negotiation. So if I were to summarize what came out of the RBI August minutes, I think one is that all committee members felt that we shouldn't look at August as a standalone policy, but rather look at what actions have been taken through 2025 and the totality of these actions, that is, including the 1% CRR cut that is going to kick into effect later this month, plus, the kind of open market operations they've been performing from the start of the year. And if we also look at the rate cuts that have been issued, these are the things that we need to be paying attention to. It's not just about that one policy meeting with the rate cut. The next thing that they wanted to study was in terms of inflation, right? So for a while, the RBI has been asking, do we look at core inflation or do we look at headline inflation? Because in one, you have volatile food and fuel prices, and in the other, you don't. And uh, because food and fuel can be transitory in nature and also not entirely under control, because you have elements like weather that could influence these prices, whether they should be looking at core inflation. So if we look at headline, you're seeing more deflation that occurs. That's where you're getting that 0.6% cut in your forecast. But core inflation has actually been closer to 4% and may pick up later on in the year. So this means that you could eventually also see higher inflation going forward. And the last thing that all policymakers sort of agreed on was that it's better for the RBI to preserve some level of optionality, which means that they want to be able to do more if they have to do more, rather than to first do a lot and then not be left with too many options. So this is why that wait and watch approach is still holding. This is why neutral is still holding as a stance, because there are risks that they're seeing from other sides, and there is a multifaceted approach to how they want to handle the situation. So uh, I think the governor spoke at an event called FIBAC earlier last month. And one of the things that they said is that we will not be found wanting. That is, the RBI will not be found wanting in terms of actions, right? So, however, the RBI can support economic growth, they will commit to doing that. And that, I think, is the biggest takeaway, because ultimately it says that the focus is on growth, right? And making sure that the economy is continuing to grow, because after all, India is one of the fastest growing economies. That is what is shaping up our macros. And growth is the only way that you can stabilize other elements like inflation as well as your unemployment numbers. So overall, we are still in a strong position. Our fundamentals are in a good place. Uh, and policy is also oriented towards growth, right? Whether we're talking about the rate cuts that the RBI has issued, the income tax slab cuts that the budget 2025 announced, or most recently the GST rationalization that you're seeing, these are all growth inducing and consumption oriented policies, right? But where we really need to see more activity is private capex. So companies really need to come forward and actually create capacity. If we look at the deputy governor, I think here what she's saying is that uh, at this point, uh, we need to be more data dependent in policy making, meaning there is no justification to cut interest rates. There is no justification to change the policy stance at this point. So unless we have more data, either that shows us that the economy is slowing down or that shows us that inflation is really picking up, we shouldn't really be changing anything at this point. But also, I think one other thing that she highlighted was that what the US does would matter a lot in terms of what we can do. If we look at Rajiv Ranjan's post, I think this is something that really signifies what the committee went through, because he says that it was one of the most difficult meetings in terms of deciding on the future course of monetary policy. So the front loading, he was not sure whether that would be enough, but you really want to be able to have firepower when you need it. So this is a situation where the RBI wants to keep powder dry, because there could be a requirement to sort of lower interest rates as we move forward in time, or lower your cost of borrowing. So, like I mentioned, that preserving optionality seems something very important. If we look at Mr. Ram Singh's comment, he's saying that there is an unpredictable set of events. So, if we wind back, let's say 1.5 months, uh, we expected some kind of negotiation to come through with respect to US tariffs, right? That didn't happen. There was a major market reaction on that day. Then nobody sort of predicted that this additional 25% tariff would get imposed, taking the net tariffs to 50%. And then you didn't really expect that Congress would oppose what Trump is doing in the US and have this matter taken up all the way to the Supreme Court. And then again, I think today we're at a standpoint where we don't know whether this is going to reverse or not. And Trump has been talking about how India has joined the darkest ally in terms of aligning with Russia and China. So I think unpredictability will remain, which is why we also need to look at ideas that are more stable, that have their own drivers, which are independent of these factors. And lastly, I think you realize that with policy, you do have to do this trade off, right? At some point, you need to prioritize something, and that may have a second order effect on another element. This is very clear in the US policy because you are seeing that constant battle between choosing either inflation management or unemployment management. And these two are often at loggerheads with each other, right? So in today's context, you want to have lower inflation, but at the same time, you need to keep the employment engine running. And sometimes to do that, you need to support the economy with lower policy rates. But that's again going to sort of give you a negative feedback loop on keeping inflation low. So I think here, like I mentioned, what really needs to happen is private capex, because from the government side, these policies have already kicked in and they're going to have a positive effect. But with any policy or any capex, there is going to be a lag, right? You're not going to see the effects immediately. So, for example, even with the GST move, you are expecting revenues to take a hit of roughly 50,000 crores in the short run, but it's likely to stabilize in the long run. And we saw that with GST 1.0 as well. That initial target of 1 lakh crore in terms of revenue per month didn't really materialize immediately. And there were a lot of people who were calling GST 1.0 like a failure. And of course, it was a much more complicated system in terms of the number of layers of tax that you had and in terms of compliance. And this new system of a two-tier system really does allow companies to comply in a much easier fashion. At the same time, you're also seeing GST collection stabilize. And then you've been able to make these reforms. So this is the time for reforms. This is the time for capex, and you do need more credit offtake. So I think that push for growth is really going to come in from here. So if we look at your inflation projections, I think here you are heading lower. We have been seeing lower and lower headline inflation, and we've also seen the forecast being revised lower. But when we look at this data in greater detail, what you're seeing is in the later half of FY26, you are going to see inflation significantly pick up. And when it comes to GDP growth, I think there are a lot of positives in the data that has materialized, because when you look at, say, the PMI indices, then it's very clear that this is not just a front loading of export orders that has caused your higher Q1 GDP growth. You are actually seeing more broad-based economic activity, but that needs to sustain. And this kind of activity has been persistent for the last 1 year. So we've been continuously in expansionary zone on the PMI, both on manufacturing as well as services. But the worrying element, of course, is that capex is not happening. And unless you have capex, you cannot really sustain growth. And with your trade conflicts and all of that going on, then whether or not, I think it'll take time for things to settle down and move into some level of normalcy. So when we look at Q1 2026 data, if we decode the numbers, like I mentioned, you have very strong manufacturing and services data when you study the PMI. You have also seen more government capex happen in Q1 this year rather than Q1 last year. And some people are flagging this, but when we look at why was there less government capex in Q1 last year, it was basically an election year, right? So then you had a lot more constraints for the government to really spend, and they, even after the elections, you had a slowdown in terms of spending, because until portfolios are allocated, you don't really get those clearances to really spend. So this year they've not had that constraint, which is why you're seeing more government capex, but it's not out of control or it's not excess capex in Q1 compared to what they can do through the year. If we look at your other thing in terms of the fiscal deficit, you see that your real growth is lower because your inflation is also lower, right? And that is something people are a little bit worried about because your deficit gets calculated on your GDP growth. But I think if we look at the overall picture, we are heading in a positive direction. So maybe the fiscal impact is not really going to be too much. What is the tariff impact if we continue to be at 50%? The estimates vary anywhere between 0.3 to 0.8% of GDP growth. So you could see a reduction in your GDP numbers by up to that much. But it really depends on how we negotiate and how we circumvent these kind of tariffs or what kind of deals we strike even with the US, because there are certain categories that are exempt from this. So if we look at IT and pharma, they're actually outside the net of tariffs. And we have also agreed to import more from the US. There are certain things that are still going on there. But the positive element, and I think if we look at all the policy changes and reforms that have been occurring, is that they're targeted towards domestic demand. So domestic demand accounts for almost 60% of our economic activity. And this is a good thing because from a domestic aspect, whether we look at what the RBI is saying, what the government is saying, or even our own personal experiences, I think their demand is still pretty good. There is a sense of growth, there is a sense of prosperity that is going on here. And lastly, we did talk a little bit about GST, and the rationalization is definitely a good move in the long run. There could be some short term impact, but I don't think that's something that we need to get too hung up on. So if we look at the India yield curve, you have seen some steepening in the longer end, and you have seen a lot of lower interest rates on the shorter end. This is something that is happening globally as well. Your longer term yields have actually moved upwards despite easier monetary policy conditions, and your short term yields have moved downwards. So, given where we are and the need for transmission, I think you could see longer term yields actually cool down because from a fundamental perspective, the valuations are stretched, and you're also seeing a lot more visibility in terms of better macros, whether you're talking about inflation, whether you're talking about growth, or any other element. We are heading into better territory. We have been stable for a while. You've even had one global rating agency upgrade India's credit rating. You've had outflows that have gone out of, foreign outflows in terms of debt and equity. So you could see India allocations actually becoming more favorable in the long run. So why are we bullish on bonds? I think rate cuts are still on the table. They're not off the table. Yes, your Q1 GDP number has been good. You're looking at good growth metrics, but there is a high level of uncertainty in where we are today, and that matters a lot. I think it's clear also from the way committee members have been talking that it's not that they want rate cuts to be off the table, which is why they are in neutral stance, but you are at a point where further easing is dependent on global actions. You cannot ease independent of what's happening across the world, right? So, and globally, especially starting with the US, you're heading into an easier phase of monetary policy. We also see that transmission has been underway, and with the CRR cuts that are going to kick in, I think you can see even more transmission that occurs. We've had that rating upgrade. We've had another rating agency maintain and keep it stable. But with the way India is progressing in terms of fiscal consolidation, compared to global peers, as well as in terms of inflation management and the kind of economic growth we are able to deliver, there is significant potential for a relook at what our actual credit rating is, and upward revisions in the credit rating can actually be triggers for foreign flows. This brings us to inflation. We've been pretty good in keeping that mandate and bringing inflation closer to 4% in the medium term. I think this year's projection keeps CPI, even if we look at core CPI, it's not really exceeding 4%, right? And you are seeing an uptick in inflation early next year. But quarter on quarter, as the RBI looks at emerging factors, we would have a clearer picture of where inflation is heading in 2027. And lastly, we need to look at assets in terms of their relative valuations at any point in the cycle. And I think today fixed income is attractively priced. You've had a significant run up in your precious metals basket. You've had a significant run up in the global basket. Your domestic equities, especially in the mid and small cap space, have been running a very crowded trade, and you have seen that part perform. Large cap, of course, is lagging a little bit on that side. And in a slower economic environment, it does make sense to look at more defensive ideas. So I'll quickly share a little bit about the program that we're running in terms of Finesse as well as Milestones to Wealth. So Finesse is an initiative where we write blogs on fixed income, we publish a monthly outlook, we run these kind of webinars where you can join us and you can sort of look at what's happening on the fixed income space. And we also help investors select products that suit them. So our investors participate in a program known as Milestones to Wealth. And this is a program where we help every investor think bigger in terms of the kind of wealth they can create. So the first goal is to take you to your first crore in savings. If you've already crossed that milestone, then we can help you set bigger targets, because that 0 to 1 is actually the toughest journey for every investor. And from there, bigger things become immediately achievable. We do this primarily through mutual fund investing, and this is a hand-folded experience where you can actually interact with our team. You're alert in terms of market opportunities. We have a lot of initiatives like Learning Saturdays, which are run through Milestones to Wealth. The basic idea being that you can dedicate an hour a week to learn something about markets and your portfolio and wealth creation. So if you're interested in signing up for Milestones to Wealth, you can either drop us a message on the chat box with your contact details, or you can really write us at info@milestones2wealth.com, or you can drop us a WhatsApp message on 9677000613. And this you can immediately, like, our team will get back to you and we can discuss what you need to focus on. So without further ado, I will open the floor for Q&A. I see we already have one question in the chat box.